Welcome to our webcast series on the new standard subsidiaries without public accountability disclosures. I'm Özlem Arslan. I'm a technical staff at the IASB. In this webcast, we would like to discuss the likely benefits of applying the standard from a regulator perspective. And our guest is Biese today. He is a member of Mexican Financial Reporting Standard Setting Board. Welcome, Bill, and thank you for joining us today. We would like to hear about your experience with the reduced disclosure framework in Mexico and your opinions on the new IFRS. So, can you please provide a brief overview on the background and the scope of your work on reduced disclosure standard?
Sure, Özlem. In Mexico, we've long been looking to find a way to reduce disclosure requirements for non-public entities. And what we found out was when this new exposure draft came out by the IFRS, the IASB, for the subsidiaries without public accountability, this is exactly what we were looking for. Reason being that the reduced disclosure requirements in the IFRS for SMEs is not something we were interested in because we don't apply that standard. And in the IFRS for SMEs, you have different recognition and different presentation and measurement requirements. So when this new disclosure came out, this proposal, we were very, very excited about it. So in July 2021 is when we started our project.
Okay, I understand. So you think it's beneficial for the entities to apply the same recognition, measurement, and presentation requirements with IFRS?
Absolutely. We have never really bought into the idea that based on your size and based on the technical skills in the company, that you should account for the same transaction in two different ways. We think the same transaction should be counted by the same principles and recognition requirements, regardless of the size or the public reporting responsibilities of the company. So when this, again, I repeat this, when this project came out in July of 2021, we found this was really going to be perfect for us. So what we did in Mexico is when this came out, we began a thorough analysis of all of the IFRS disclosure reporting requirements and full standards, compared them to the reporting requirements in this proposal, and we looked to see why you had cut out and reduced certain disclosure requirements. And so we did that. And how do we do it? In Mexico, our new standard with reduced disclosure reporting is not yet in effect. However, we hope it will go into effect in 2025. And the way we did this was, after that thorough analysis, we looked at all of the disclosures and all of our standards, and we said, we called the disclosures that are for all entities to be general disclosures, and then there were separate disclosures that are just required by public interest entities. I suppose one of the most controversial items, especially in our exposure draft, was what is a public interest entity? And so people have had some comments and questions on that. And we may be refining that just a little bit. However, one of the things I thought was most interesting, since the original proposal was to reduce disclosures, we were surprised to find out people did not say, you forgot to separate this for public interest entities. You forgot to separate that. It was on the contrary. What people said was, you segregated too much. Bring it back to general. And that was very surprising to us. And I've heard that that's been experienced in many areas. Other countries, like on the panel I was in a few days ago with New Zealand and England, have long had projects like this. And they have also experienced the same thing. That is to say, very often what they said was only required for public companies over time has come back to general disclosures.
Can you please share your views on having a global reduced disclosure standard?
The benefits are clear, as far as I can tell. The benefits are clear because the users of the financial statements of non-public interest entities are very different from those of private entities. For public companies, your users of the financial statements and the preparers, the management, are two different groups of people in most cases. There may be some overlap, but they're two different groups of people. Not the case with non-public interest entities. For non-public interest entities, the users of the financial statements and preparers are very often the same group of people. And so what we finally concluded was that for effective communication, you shouldn't overload non-public interest entities with disclosures that nobody's looking at. In fact, one of the things we thought about is, and I've seen this before when I was an auditor for many years, in corporate reporting packages. Corporate reporting packages from the subsidiary up to the top don't include everything that's going to be disclosed up above. They ask for the things that are important to them. And so I would say that if they don't even ask their subsidiary to report to the parent certain items, certain disclosures, that's usually a good indication, although not authoritative, about what should be disclosed. One of the things we're going to definitely look at, though, at the same time is, and we think that the exposure, the scope of the project is very clear for us. It should be for all entities, not just subsidiaries. And there's been a lot of discussion. That decision has not yet been made. I asked one of the board members of the IASB one time, will they make that look? He said, look, once we have this standard in effect, which is expected to be issued this year, going to effect in 2027, we'll do a post-implementation review in 2-3 years after that. And depending on the results of that, we may or may not, we will consider, but we may or may not expose or expand the scope of the project. But at this point in time, it's so clear that the disclosure overload for people that are only issuing financial statements for a bank, for a supplier, for a creditor, for a customer, these people don't need all disclosures that are required for public companies, primarily because the users are just a whole different group of people. Thank you.
Thank you. To summarize, you said there was a demand for reduced disclosure for non-public entities in your jurisdiction, yes, in Mexico. And you believe that the reduction of the disclosures will improve the cost-benefit balance for these entities.
Yeah, absolutely.
And the reduced disclosures are aligned with their users' needs because the users are very different.
That's a very good summary. Absolutely. The cost benefit is really there. Right now, for a small company to report all the disclosures, and by the way, the Mexican standards up till this recent project, which took a year of study, up to this recent project, the Mexican standards were based on disclosure requirements of full IFRS. And that's why people have been saying, when are you going to take into account that the users of these financial statements are different? And that's what we're doing right now. So we've gotten great support for the project, and we hope to publish it soon.
Thank you for your time and sharing your opinions with us. That concludes our webcast on the likely benefits of applying subsidiaries without public accountability disclosures. Thank you.